Record. Well, welcome everyone. My name is Paul. As you know, we got Costas. Is it Kivelos or Kivelos?
Kivelos.
Kivelos. I got it all wrong. So we got Costas Kivelos here. I really like Costas' energy, and what I like most about Costas is that he walks his talk. So not only is he helping investors, make great profits, make great ROI, and create wealth for them over the long term, he's doing the same thing. He's practicing what he preaches, and he's walking his talk. And I always like to have those kind of people on with us, because that's kind of my energy. And if you're going to give advice to people, I feel like you should be eating your own meals. You know what I mean? I think everyone kind of gets what I mean there. And I really like that about Costas. He's got a lot of experience from a different angle than I have. And that's why I brought him on here. So, but before we hear what Costas had to say, I want to share with you kind of my own little plan here. And, I see a lot of new faces here. And if you don't know me, my name is Paul. I've been an investor since 2009, 10. I bought my first property. And I've been a realtor since 2010. All I do is work with investors. I don't do the residential game. The whole realtor thing was born out of me being an investor and kind of wanting the best kind of representation. And I started doing deals for myself. And then, we just kind of grew this massive network. And this is kind of how it ended up. We like to teach, we like to educate. And we think that's important. And the right people and the people who like to work with that kind of energy are attracted to us. And that's how we roll. And we've built a big network and a big client base who often repeats investments. And we become like a small family, and it's fantastic. So when I do this research, I'm doing it for myself first, because I'm an investor. I have single family homes. I have duplexes, triplexes, fourplexes, sixplexes, larger multifamily. We're doing multiple different developments right now, from raw land to building 26 townhouses. We just finished building 18 townhouses. What else are we doing? Duplex conversions, triplex conversions. We have Airbnbs, short-term rental properties outside of the country. So, and all that stuff that we're doing internally helps us educate you guys and helps shine a light to places that not everyone can be in at the same time, right? So that's the energy we're coming from with, and this plan and this research that I did for myself, because like you, I'm asking the same questions. What the hell is going on here? Where are interest rates headed? Should I be buying? Should I be selling? Should I be refinancing? How is this all going to play, right? And the focus and what's driving my targets and my research is that my aim is to be a sophisticated investor. And what that means to me is that you're able to make money in any type of market. Everybody's a hero when the market's going up, right? We all know what that feels like. So when the market's kind of wobbly or, can't find itself, kind of like where it is right now, we still got to make money if we're real investors. And if the market's coming down, we got to make money. We got to be ready for opportunities. And if rates are going up, rates are going down, whatever's happening, I want to be sophisticated enough, resourceful enough, and have the right people and networks like Costas to be able to pounce on good deals and get access to things that I can't get access to. So that's where my energy is coming from. And I think that goes along with my little quote here. And I learned this the other day. I love it. You can't see your reflection in a pot of boiling water, right? The water has to be still for you to see clearly your reflection, right? The truth is only available to those who can see and think with a clear and objective mind. Fear and emotions cloud your judgments and clarity, right? We got to be still. We got to get rid of the nonsense so we can see and think clearly, right? So first thing I did was starting about 4 months ago, was start to refinance. Okay, I refinanced 4 properties. 2 of them were to kind of repay back some major improvements I made. I converted 2 houses and I added units into them, secondary units. So I repaid back all the money I spent there. And the third one, I added a big HELOC. And the fourth one, I just took the cash and increased the mortgage. And now we have, I had some cash already, but now we have a pretty sizable war chest built up. And I think that's important as a buffer. If we're going into a period of uncertainty, you kind of want to have cash for anything and everything, for good opportunities, in case rates go up, and these are a cash call and all kinds of things, right? So some perspective I've been getting from some of my mortgage brokers. I apologize for reading to you, but these are some important points. For clients that are currently in mortgages where the payments have increased substantially due to being in a variable or recently renewed at a higher rate, a refinance can allow you to extend the amortization and reduce your mortgage payment. You might be thinking, why am I refinancing if rates are going up? I extended my amortization. Yes, from today forward, it could take me longer to pay off the mortgage, but that's not my intention. My intention is to manage my equity and be an asset manager, right? So I got my payments back down into an affordable zone while accessing more cash to take advantage of more opportunities, okay? And sometimes it makes more sense to write out the variable and wait for fixed rates to come down before locking in. And then sometimes it makes more sense for you to stay the course and wait until your next mortgage renewal. And I'm not the one to answer that question for you. You have to talk to your mortgage advisor, and I say advisor on purpose because not all professionals are created equal, and we have some really good ones who are investor focused, like Costas and I, that we can introduce you to if you need one. Okay, so these were the options that I played with. So a short-term fixed rate, 1 to 2 years. So if I think rates are going to be crazy for the next couple of years, I can lock in, pay a little bit higher, and what I'm essentially buying is insurance. I'm paying a higher monthly payment, but it's insurance. I know it's going to be fixed if I'm, if that's where I need to sleep. But a 1 to 2 year term, it's a digestible period where planning becomes much easier, and you're not in a position to sell in a short time frame. It doesn't make sense if you're going to take a fixed rate, okay, or suddenly have to break your mortgage. So that's what you have to plan for. I'm not selling this property for 1 or 2 years guaranteed, or I'm going to take a massive hit. The short terms will also coincide with the time frame that most economists see rates coming back down, right? So that's a pretty good, strategy. If you think, and we're going to get into it more, rates should be coming down in the next 18 to 24 months. So if you want to lock in, not a bad idea if it's a really long-term property. And that way you'll be in the best position to renegotiate. A 5-year variable, if you want to get the low, and this is what I did, to be honest with everybody, I took variable on everything. If you want to get the lowest possible rate these days, but are okay with rate fluctuations, this is still the most attractive option historically, with additional rate increases likely to come. You'll see the rate change, but on average over a 5-year term will likely do much better than locking into a 5-year fix. I think a 5-year fix would be absolutely insane, but something for everybody, which on average is sitting in the mid-5s these days. Okay, and you can get variable rates lower than that. We just closed a couple of deals and they were in the 4.5 range. Okay, and the HELOC, we all know what HELOCs are, home equity line of credit. You can fund whatever you want, okay, including emergencies and other, more investments. But when you're using the HELOC, remember, you're not paying principal pay down, you're paying the interest, right, only back. So you're using borrowed money at a much less, at a smaller cost. So it has its advantages. It's a tax write-off. This isn't a tax course, so I'm not going to spend too much time there, but the HELOC plays a big role if you have equity and you just want to unlock it. If I have 500,000 or 300,000 in equity, I can just unlock it with a HELOC, have it sit there and use what I need. Use 100, no problem, pay it back. Use 200, pay it back. And I'm only paying interest on what I'm using, and it's interest only. Okay, on a $500,000 HELOC compared to a mortgage, you're paying $800 a month less. All of it going toward interest and not principal. Okay, and it'll improve your cash flow in the short term. That's the point. Okay, I see a lot of questions. I'm going to race through this because and we'll take questions in the end because I want to let Costas hear what he has to say. Costas, I saw your presentation. You got this. One of these is the same, so I won't spend too much time here, buddy. But in the past 30 years, we've seen 6 periods of interest rate increases, and during those 6 increases, they range from about 1.25% up to 3.2%. Okay. Interestingly, all these hiking cycles average, some longer, some shorter, were 13 months in duration. We're currently 4 months into the cycle, approximately 4 months, and these 6 periods began a decline cycle on average 5.7 months after the last rate hike. Also, the average interest rate hike was about 1.95%, and the average decline was 2.85%, which I found very interesting because, like anything the government does, they overshoot like an elastic band, right? Overshoot too high, overshoot too low. Standard operating procedure, it seems to be. That's why you see all these waves, right? So, Costas is going to talk about the graph and the charts. And I'll say it's very important to remember that the current interest rate environment, although we have to deal with it now, is not long-term or permanent, and ultimately a coordinated effort by the Bank of Canada to ensure inflation is under control. I love that statement because guess who caused the inflation to begin with? We don't have to go there, but you know what I'm talking about. These rate increases will ultimately cease, and we'll then start to see some rate declines. We don't expect rates to drop to COVID levels, but certainly much lower than what we're currently seeing. Now, you'll probably see something like this on the news, right? To scare everybody. I love it. Makes me laugh. But if we just look at prime rates, and remember, there was a financial crisis, right? All hell is breaking loose, 2008, 2009. And we went from 3 to 2.25, our prime rate. And now, we fluttered around basically the same spot, a little bit up, a little bit down, and then bang, that's COVID. So look at the fluctuations, almost nothing. And since, in the last couple of months, we went bang all the way up to 4.75, right? And it seems like we're at record highs, but in reality, it's not even close. Okay, don't listen to the news. Look at this over 80 years, right? Prime rates averaged about 5%. So are we at record highs? Not even close. Not even close. And fun fact, 1971, what happened in 1971? Richard Nixon took us off the gold standard. And what the hell happened after money wasn't backed by gold and wasn't real money anymore? Inflation like crazy, right? Inflation like crazy. And then what happened is they printed billions upon hundreds of billions, and now we're into the hundreds of trillions of dollars. And now we have hundreds of trillions of dollars in global debt. So how do you raise interest rates all the way up here when you're paying debt on God knows what it is, $300 trillion? It's an unfathomable number, okay? So how much can they raise it, and how sustainable is it over the long term? Okay, keep that stuff in mind when you're playing the game. So 2, what am I doing? I'm taking advantage of rising rents. What's very interesting is that prices are falling in many spots from kind of artificial peak highs, let's be honest, but still falling, to be fair, but rents are through the roof, okay? Landlords are not stupid. You guys are smart. So if your costs are going up, guess what's going to happen? Rents go up, and that's what's happening. Rents are up 5, 10, 15, even 20% in some spots. So if you have a vacancy, make sure you're taking advantage of that. You have no choice. It's your business. You need to take advantage where you can, okay? And if you have the mindset that you're not in a space to be buying new properties or securing new investments right now while things are uncertain, I don't blame you. It's your business, and you need to run it the way you see fit. But maybe you might access some capital to improve the properties you already have, right? Why not add another unit to the basement, or take your duplex from a duplex to a triplex, or I do the garden suite, or whatever it is, okay? And it's also interesting, and it has to do with the cash flow, is many banks, and I'm going to explain this in more detail, are extending amortizations and allowing monthly payments to stay the same rather than automatically increasing payments with each rate increase. So you'd assume that if you have I'm just making numbers up, a $500,000 mortgage, and your interest rate was 2%, if it went up to 2.5%, 3%, 3.5%, 4%, every month your payment's going to go up too, right? Well, wrong. Okay, wrong. The bank isn't that stupid. They're greedy, but not stupid. You can't tell them, you can't assume that they're that dumb. Okay, if they started raising payments on every Tom, Dick, and Harry, $500, $1,000, $1,500, $2,000 a month as these rates increase, they'd have bankruptcies, we'd have a bank run, banks would go nuts, our economy would explode. Like, it's a serious game, okay? And I just left the bank yesterday, okay? I'm showing you this real time from CIBC. Delmar, one of my addresses, What they did is leave the payment the same, but extend the amortization of the mortgage in order to balance out the payment and leave it exactly the same. What that means is, when the rate was low, I was paying mostly principal and a little bit of interest. Now we're paying more interest, half principal. And if rate keeps going, they're going to leave the payment the same, and we'll pay more interest and the least amount of principal. It's up to me to raise the payment if I want to, which nobody's talking about. Okay. The only thing you have to be cognizant about. Oh, I got to mute somebody here. Oh, there we go. The only thing you have to be mindful of is the trigger payment. And I didn't even know what this was until I did the research. This is for borrowers with a variable rate mortgage with a lender where monthly payments don't increase when prime goes up, what I just explained to you, and many of the banks are doing it, compared to an adjustable rate mortgage where your payments will move with prime increases. Many borrowers went into a variable rate mortgage to get the lower rate option, but stable payment of a fixed mortgage. Trigger payments have often been ignored, as we haven't seen such significant rate increases since the late 70s. The trigger payment is the level at which your regular mortgage payment no longer covers the interest portion of your payment and will require you to increase your regular payment to align with current rate fluctuations. Sometimes a lump sum payment could be required to bring your amortization in line, with the maximum. For some who have become accustomed to the regular payment, this could be a significant jump with all the increases we've seen this year. Check with your lender, right? So if they leave your payment the same and interest rate increases, and now your payment can't cover the actual interest portion, then they're going to say, hey, pony up, which is why you want to have cash on hand or be able to absorb the extra monthly payment with cash flow. Okay, we're telling a story here. So, and I just showed you what CIBC was doing. They were telling me, hey, every mortgage you have, this one should be increased by $272.32 to equal the amortization you had before. They went through every mortgage and told me which one. I said, thank you, give me that piece of paper, I need that. And I took it home with me. I haven't done anything since. Okay, the third thing is be ready to score a good deal. Okay, both a cash flow type property and a good pre-construction project. Okay, and we're going to talk about why that's important. As demand falls, prices will stabilize and eventually reach an equilibrium between pricing, cash flow, and rates. Investors are not stupid. If we're going to buy a cash flowing property, we're going to make sure it cash flows. And generally, the minimum cash flow we're going to accept on the open market is somewhere in that 5 to 6% cap rate. I'm not going to explain what a cap rate is. If you need some coaching on that, I'll help you. But as rents are increasing, payments are increasing, prices are coming down, we're finding this equilibrium, and the market's going to settle, and it's going to be an opportunity, right? People are not going to know what they're going to do, and good investors are going to scoop up good deals. Okay. Demand in the GTA is unprecedented. We all know this. Canadian immigration levels and future targets, more importantly, are at all-time highs. Development, and Costas is going to talk about this, is not keeping pace. Whether it's Ontario, the Fed, CMHC, they're all calling for massive shortages. We're short anywhere 300 to 1.6 million homes, depending who's doing the numbers. And this is where pre-construction is going to come into play big time. Okay, said in a different way, we have 100,000 new family formations a year, and we only produce 70,000 units, and that's about to decrease. Okay, we're going to talk about that in a second. Okay, so we have high demand and low supply is baked into the formula every year. Never mind all the immigration that's coming in, right? So, and then global debt to GDP is 4 to 1. Okay, 4 to 1. That means, let's say the world creates $1 trillion in income. We have 4 trillion in debt. That's like saying Costas makes 100 grand a year, but he's 400,000 in consumer debt, not mortgage debt, consumer debt. Right? So if we don't have inflation, how are you going to create more dollars to pay back the debt? Okay, that's a perpetual debt cycle. That's what we have. So inflation is absolutely necessary to keep this rigged game going. And inflation always rewards asset holders. And if you're going to hold assets, assets with cash flow are the best ones. Okay, at least I think. The opportunity is this. Well, everyone's freaking out about pricing in the short term. The sophisticated investor acts with confidence and takes advantage of buying opportunities while they can. Okay. As an investor, it's important to put things into perspective. Turn off the TV, please, God, turn off the TV and focus on opportunities that this will create. Okay. Prices likely to continue to soften in the short term. You can still line up capital by getting HELOCs and refinancing for sure. Banks don't stop lending. Remember, what do dogs do? Dogs bark, right? If the dog stops barking, the dog's dead. Okay. If the bank stops lending, the bank is dead. Simple. Okay. Banks lend. That's where their money comes from. So, and you can get a conditional offer. Did you know that? We're not doing multiple offers anymore. That game is over. No more 27 offers. So you can actually get a conditional offer and negotiate with the seller. It's amazing to see. And we're doing it right now. Okay. And you'll be able to buy hard assets that are hedging against 40-year record high inflation without, competing against 27 nutbags, making crazy 200,000 over asking offers. Okay. And quality pre-construction projects are going to be a massive opportunity. Okay. Relax. The sky's not falling. Real estate's not going to zero. Take a deep breath. Look for the opportunity. Okay. Sophisticated investors look at the fundamentals and not the headlines. This really reminds me of the 2009-10 crisis. And I was telling myself, don't watch the news, don't watch the news, don't watch the news. Listen to my coach, buy the property, everything's going to be fine. It worked. So don't be that person, right? We're all human. We all have feelings and emotions, but we got to regulate them if we're going to be investors. Okay. And what if we're wrong about real estate prices going up ever again? Well, at least you have an asset that produces income. In an environment where nobody's working and the government's paying them, and recession and GDP is decreasing while debt's increasing, it's nice to have an asset that's giving passive income. That's the real unicorn. Okay. So what's next? We're going to talk about that at the end. I want to give you some things to put into place right away, but I've been talking too long. I want to get Costas talking because that's what he's here for. Kayla, go ahead and share. I hope that was quick enough for you guys. I see your questions, folks. We'll jump into it at the end.
Well, thank you, Paul. Paul made a comment about similar people attract, and you want to work with similar people. Well, the energy you put out in the world, it seems like I got the energy back, and everything that Paul just talked to you guys about, I echo and repeat on every webinar and seminar I get a chance to do. I'm a firm believer in everything that he just stated. And this is a golden time to buy pre-con. HELOCs are a way that many people have become real estate investors with the equity that they built up over the past few years. To touch on it briefly again, don't listen to the news. The news sensationalizes reality to attract viewers. It doesn't really tell you what's going on. And I'm going to repeat some of the same things he said, but go in a little bit more in depth and cover it from my own angle and tell you why pre-con has been the best way to make money in real estate. And I like to say that because I back it up with my numbers. We've been averaging 50% annualized returns on our deposit over the course of the build. And it's a way that I've established a great amount of wealth for myself and a lot of my clients. And we're going to talk about that. I'm going to get into a brief introduction. This is the one part that I don't really like doing. I got to almost tell you who I am. And at the same time, it sounds like I'm patting myself on the back, but I want to let you know why you should give what I say an opportunity to sink in. So I'm the founder of First Access Condos. I've been in the real estate game over 12 years. I'm an avid pre-construction investor. I've been selling pre-construction exclusively for over 6 years. Time flies. I work for the largest independently owned brokerage in the country. We have over close to 6,000 agents. I was number one in 2021. I have over 1,000 happy clients, over 1,000 condos sold, and we sell a lot more than $100 million in real estate every year. So you could say that I'm probably an expert in the field, and I think you should listen because I've made a lot of people a lot of money, and I think I can do the same for you. So pre-construction is a little different than buying resale real estate. And we'll talk about that after, and I'll break it down the differences. But what I really want to do is jump in and tackle the elephant in the room. So everybody's talking about interest rates right now and where they are and how they're going to skyrocket. And my dad was an investor back in the early 80s, and I heard horror stories of 20% interest rates. And just to put your mind at ease, everybody, they're never going to come back down. There's too much money circulating in the world. There's too much money printed, as Paul touched on. And that is basically a horror sci-fi flick from an alternate universe, those 20% rates. We're not going to see them again. But what I want to talk about is interest rates. And when you learn your past, you can prepare for the future and be ready for today. And I'm a big student of history and war because I think it applies to business. And when it comes to investing money, you really should know what has happened over the previous decade, 2 decades. And because there's really a cycle that we see. And when we look at the Bank of Canada's overnight rate, when we go back 20 years, we see, like Paul mentioned, we got 6 significant rate hikes. And every time the bank raised the rate, okay, over the course of the next 12 to 18 months, the rates came back down. Now, it's not that they came back down, but where they ended up was actually lower than where they started each and every single time. Okay, so what you see is when the rate spikes up, they come back down to a lower overnight lending rate than when it started. So what that means, if we go up, we should statistically, based on precedent, come back down to where we started or below. Now, this might be the exception because we started so low, almost at zero. Okay, we might not be able to go lower, but even if we get back, it is still significantly cheaper. So the key message here is that we should not panic about runaway rate hikes. They will continue to rise, but it is also very likely that we will see rates fall shortly after the hike stop. Maybe this rollover will happen by the end of this year or at some point in 2023, but being prepared for the scenario will allow for some investment opportunities and debt opportunities to be maximized. And whether you use the fancy footwork when it comes to mortgages that Paul just described, or whether you sit tight, okay, what you need to keep in mind is that the sky isn't falling. All storms pass. And this is one of those cases. And in the last 6 months, you've heard me quote Warren Buffett a lot. And he said, when it comes to investing, when people are greedy, it's time to be cautious. But when people are cautious, it's time to be greedy. And the greatest fortunes throughout history haven't been made at the good times. They were actually created at the worst of times, when people went opposite the herd. That is why everybody on the planet is not a multi-billionaire, because if everybody does what everybody else does, that's when success is not attained. It's the people that have basically the know-how through education, listening to people like Paul, myself, and others that are considered experts in the field, but they also have, in part of the term, but they have the balls, the kahunas, to actually go against the crowd. And that's when you see you'll make money. So if we look at condo sales, okay, over the past almost 10 years again, you're going to see that this year we're at the 10-year average, okay? So even though everybody's talking about how sales volume is in the dumps and it's in the toilet and no one's buying anything, if you look at new condominium apartment sales, they are at a 10-year average. So we've already seen 2 significant steps of misinformation by the media. We saw one about them talking about rates, but have you not heard, because I haven't heard it, but maybe you have, but the media has never once said that up until the last rate hike, we were at the level of interest rates that we started COVID with. But back then, nobody was talking about it because the media wasn't promoting it. And they're also talking about sales volume and no one's buying anything and this and that. But if you look, we've sold the 10-year average, actually surpassed it for new condo sales. So the Greater Toronto new condominium sales totaled 6,792 units in the second quarter, declining 19% from the first and 24% year over year, but remaining above the 10-year average of 6,300. Activity was supported by the launch of 9,900 new pre-sale condos in the second quarter, which represented the third highest volume of new units brought to market on record, exceeding the 10-year average by 43%. So this year, if it wasn't for the Bank of Canada finally doing something about interest, because as Paul said, we don't want to get into this, but we know that the government caused this inflation and the bank did not do its job and actually act during COVID. But when they finally did, we were on track to have the most units sold ever in a year in the GTHA. And a little known fact for food for thought for you guys, we sell more pre-construction product in Southern Ontario than any other region of the world. And there's a reason for this. The absorption rate for new projects launched in Q2 declined 57%, down significantly from 81% recorded during both previous quarters and in the same time last year, but only slightly below the 10-year average. So now we see that condo sales actually slowed. So they didn't get absorbed by the market. And what does that mean? We'll go to the next slide. When developer has product and it doesn't sell, developers a lot of times will back off and relaunch later. And what's that going to do? Well, we'll touch on that soon. But look at this. New condo pricing per square foot. New condo prices for available units continued to escalating to reach a record high, averaging $1,450 per square foot in the second quarter of 2022, up 4% quarter over quarter and 20% year over year, partly a result of an increase in inventory at higher priced projects. But why are these prices coming up? See, a lot of people, and everyone's got an opinion, we all know what they're like, but a lot of people, you're going to hear a lot of the noise telling you that pre-construction product's going to come down in price. Now, in the last 12 months, we have seen rising construction costs. Construction costs are up 20% this year alone, labor shortages, massive increases in development charges. The City of Toronto City Council just approved a 49% interest increase, higher interest rates that developers have to pay, and lengthy approval times, okay, at the OMB and at City Hall. There appears to be little room, if any, for new condo prices to adjust or lower. Now, I speak to a lot of developers firsthand, and they ask me for my opinion before they actually purchase land to build. And I help them with their pro formas and stuff because I can forecast what I'm going to sell them. And I'm telling you that prices cannot come down. They're only going to go up. And what's going to happen is developers are going to delay launches, causing a shortage of inventory coming to market in 4 to 5 years. And we all know when demand continues to increase, but a product becomes even more scarce, prices go up. The mild decline in condo resale prices, which decreased 4.9% from a high of just under $1,000 in square foot in Q1 to $940 in Q2, and still at low inventory levels, aren't creating urgency for price reductions. So unlike 2017 in the low-rise market, when we saw a price correction because sellers flooded the market again, caused by the media saying our bubble was going to burst, and we've never been in the bubble. For educated people like ourselves, we know that it's strictly supply and demand. Currently, a lot of people aren't selling. And if they don't get the price they want, they back off and they rent it. So that means prices are going to stay stable, even through the next little while of uncertainty. So what has happened where prices aren't really coming down? Instead, the main way projects have reached the slowdown is by canceling or delaying their plans to launch. At the beginning of the year, okay, we anticipated 35,000 new condo units to launch, and close over 80%, we said the historical average, we're going to get absorbed / sold. In the first half of this year, close to 16,000 units launched, with less than 10,000 units expected during the rest of 2022. This leaves us 10,000 units short, and these units will be put on the shelf, further exacerbating the scarcity of real estate in our region. Now, I love to share this slide with as many people as I can, because the media and social media, because all they do is jump on bandwagon, most people, okay, the keyboard warriors, they don't actually know who makes the money with these new projects. So we've created this graph, my team and I, okay, on my discussion with multiple developers and people at City Hall, and we broke it down for you. And the reason this is important, imperative to have in the back of your mind, is when you're investing money, you need to know all sides of the story. And now we're going to see here if really development prices are going to come down for new development. Prices, will they come down? So what we see here, let's start at the bottom and we'll work the ground up. Land value is between 10 and 30% of the full build. Construction costs are 30 to 40. Excuse me. And this year, they're closer to 40. Soft cost, which is all the applications, all the marketing, all the hoopla, that's between 14 and 25. Government charges and hyper focus on these numbers are between 18 and 22% of the build. So the developer is left with a margin of 7 to 13%. Now, if we said that construction costs have gone upwards of 21% increase this year, okay, that profit margin is much closer to 7 for most developers than 13. So how are you going to build and drop prices and bring your margins even lower? And any of us that has done construction knows there are always unforeseen expenses. A project is not viable if the margin goes too low. So they have no meat left on the bone, and that's why prices will not go down. But let's look at here. Who has both hands in the cookie jar up to their shoulders? The government. An average condominium price of $750,000, the government gets $160,000. So let that be food for thought. And what they've done is they've increased development charges by 49%. They brought in an archaic form of housing assistance called inclusionary zoning, which is going to start destroying affordability for everybody who's not already set, with new applications starting September 23rd, and making everything more difficult. The government doesn't care about affordable housing, and the government doesn't care about you or I. The government cares about getting their money, and they are going about helping people in the worst possible way ever, because they're not helping people. They're killing affordability. They're going to make it near impossible for new families to get into the market, because with our calculations, for these buildings that have an inclusionary zoning component, it's starting at 5% of your building for the first few years, then it goes 10, and then it goes up to 15. But at 5%, that'll increase the average price of a unit by 8% overnight. And with the average rent of a one bedroom in the core of Toronto, well north of 800,000, you're looking at 64 to 85, that's my figure, $1,000 more overnight for projects that have this inclusionary zoning component. That also is going to be coupled with a 49% increase in development charges. Now, how is the government making it more affordable? Next slide, please. Now, we deal with investors, Paul deals with investors, and the vast majority of my clients are investors, and I'm an investor. So when we look at the uncertainty that's happening today, okay, and when I ask myself, where am I going to put my money? Well, throughout history, you should invest in a need, not a want. Something that's a requirement, not something that's trendy. Something that will stand the test of time. And if someone will need it today, and someone will need it tomorrow, and someone will need it 10 years from now. And what is there really a need in our region? And that's housing. We have huge shortages of housing. RBC a couple of years ago said we were 26,000 units short. CMH said we were 32, okay? Now, why is this? These are 1,000 units short a year. Now, because of that, and because anybody that drives in Toronto knows that our infrastructure wasn't designed for this many people, knows that Toronto is a traffic nightmare and is getting more difficult to get around. And we all know that the government can't even build a subway in 10 years because Eglinton's still a disaster. So we really are going to start seeing a shift to people moving closer to work, living where it is convenient. And that is why we're seeing condo booms, okay? So I've decided that pre-construction, when I've done all the research, is the best way to go. Now, we said that pre-construction condos in general, okay, are a good investment. and that they're not going to get cheaper for the other reasons I told you. But let's talk a bit about immigration as well. There's a 2.7 million person backlog to get into our country. That's 2.7 million people in queue. Over half of them want to come to Toronto or are going to try to get here. Okay, that means we already have 200,000 people a year coming to Toronto. Now, if you look at the numbers the city gives you, they're going to say, oh, in the last couple of years, we're the #1 destination in North America, just beating out Dallas, Fort Worth, and we had 137,000 people a year coming to the city. Did we? Yes, but that's from out of Canada. We also have close to 20,000 people coming plus a year interprovincially, and we have 100,000 foreign students coming to our Greater Toronto Hamilton area every year as well. So we're close to 250,000 new people every year. How are we going to house these people? Well, the city can't really build because of geographic constraints like the lake and government imposed constraints like the green belts. So we have to go vertical. The future is vertical, it's density, and that's where condos come in. Well, let's get back to that a little bit later. As we have explained, interest rates are cyclical. By the time the projects launch, so by the time the projects are completed and you need a mortgage, rates will be back down. And that's for sure. Now, it doesn't matter who you ask, but unless you're the government of the United States and you just change the definition of a recession to suit your business model, okay? Recessions are 2 consecutive quarters of stagnated or negative economic growth, okay? What happens is the Bank of Canada is increasing rates to combat inflation. What that'll do is push us into a recession. A lot of people think we're already in one. Once we have 2 rates of negative growth, then the bank will most likely start lowering rates to increase, to create growth again, to create business, to basically kickstart the economy. And like Paul said, the government has a rubber band and it just flings it. And it doesn't stop where it wants, it overshoots. And that's basically what they did. And I'm quite happy that they raised rates by 1%, because that'll bring this to an end even quicker. As sales volumes decrease, we see an inverse relationship with rents. A slowdown in overall sales in the next few years will cause rents to catapult in the same time frame. By the time the pre-construction units come to market, rents will be at levels never seen before. So yes, prices are expensive. And a gentleman asked me about rates and rents and cash flow. Well, listen, the days of making substantial cash flow monthly from condos in the GTHA are gone. These are not cash flow purchases. These are capital appreciation purchases, and they need to complement cash flow purchases in your portfolio if that's what you're looking for. But like all the other major metropolises in the world, a lot of those places, including Toronto, they're capital appreciation plays. So what do we see here? We see population increasing at never before seen levels, further exacerbating the housing shortage and demand. We see interest rates being cyclical. With projects closing, rates will be well below where they are today, okay? And we see rents rising. So this is the perfect storm of opportunity to buy pre-construction. As development charges, construction costs increase, and the introduction of inclusionary zoning, developers will have no choice but to raise prices, regardless of market demand. We forecast that inclusionary zoning will increase prices by 8 to 10% overnight. Remember these. I'm repeating this stuff because these are buzzwords for us to remember. Development charges have already increased by 49% in the city of Toronto. These increases will raise the price of pre-con, pushing more buyers to resale, which will further increase resale prices until pre-con becomes attractive again. Either way, by the time your condo is built, everything will be more expensive. So listen to that, and I'm going to repeat it. When inclusionary zoning comes in and development charges increase, pre-construction is going to skyrocket in price. It'll cause a shock to the buyer pool. People will say, I can buy resale. And yes, you can. But a large portion will start buying resale. Because people are closed-minded. They see today, they see tomorrow, but they don't see a month down the road, a year down the road. In our type of investing, it's 4 or 5 years down the road. We have the gift of foresight, okay? So when a large section of pre-con buyers, because money can't sit still, because example today, you're gonna lose 10% of your money if you keep it in the bank year over year. It's value. So this money needs to be invested. So people are gonna buy pre-con, they flood the resale market. This will increase resale demand, fixed supply, it'll skyrocket resale product. In the meantime, if you buy a condo today, it'll be ready in 5 years. By the time it's ready, resale will have skyrocketed. That'll benefit your pre-con purchase because people will start buying pre-con again. And by the time it's ready, prices have skyrocketed. There is no way else to cut this pie. Our prices will increase because we have never been in a speculatory bubble. We are a supply and demand-based real estate economy, and we can't build it close fast enough. These increases will raise the price of pre-con, pushing more buyers to resale, which will further increase resale prices until pre-con becomes attractive again. Either way, by the time your condo is ready, everything will be more expensive. I purposely repeated that because that's what you should leave with us today. Demand. 2.7 million in queue to get into Canada and over half forecasted to come to our region. The demand for housing is only going to increase. Once we factor in the amount of units that will not be built this year, this will further the scarcity of housing in our region. Basic supply and demand states if a product decreases in supply, but demand continues to increase, that product will be more valuable and more expensive to purchase. Now, because some people learn audio, some learn visual, we put this in a graph, okay? The GTA is short on average 30,000 units every year to get a balanced real estate market. And this doesn't matter who you ask, okay? This is kind of the mean in between all the numbers. The demand will far exceed the supply within the next 5 years from now when these units don't get sold and don't get built. We'll have less product coming to market. So by the time the market picks up again, I don't really think it's going to be gangbusters in the fall because we need to see 2 consecutive quarters of negative economic growth. But as soon as rates come down, as soon as there's a blip on the downward side, the market's going to explode, okay? But this year for sure, we're going to be 10 to 15,000 units short being sold. So when you add the year over year lack of units, okay, that we can't build because we don't have the construction companies, we don't have the government that's willing to do it, they just don't get done, okay? But when you add those and then you further make it worse by 15,000 units being short 4 to 5 years from now, imagine what your new pre-construction condo will be worth. It'll be worth its weight in gold. Now, I know there was a lot of information, and we're going to talk a little bit more after about how you invest in pre-con, how it differs. But now, before I bore you guys too much, okay, I want to talk about some quality projects that are currently selling and one is about to sell. These projects I handpicked. We sell over 40 different pre-construction projects a year, my team, okay? Over 40. I picked 4 to discuss with you today. Now, this project is not selling yet. This is going to start selling mid to late September. It is being built by Reserve and Capital Developments, and it is those 2 great companies' flagship project. I currently own condos in 2 capital development projects. I am the person they call when they are looking at land. They are redeveloping Yonge St. Clair with the Weston family, and we've all heard of them. And Whittinghouse, their Weston family's real estate division, I was the only realtor called in to talk to them about what I think would do well and complement the area and sell well. So I know the ins and outs of this company. I put my money where my mouth is. I walk the talk and I buy there. And this is why I started off with this one. This is going to be a flagship project, the likes of which are very far and very slim pickings in our country, projects like this, and basically North America, okay? It's located at 8 Elm Street. And for those of you that know or don't, this is on just at the corner of Yonge and Elm, which is situated between Gerrard and Dundas. Now, when it comes to investing in First Access condos, I have a checklist that I vet projects before we sell them. Over 100 projects approach us every year to sell, and we choose about 40. So 1 out of every 2 doesn't make the cut. The reason we screen these is so that you don't have to. But our checklist basically goes as follows. Is there proximity to transit? Is there education, higher education near you, or employment hubs? Okay. Is the developer reputable? And where do we see this in the future? Is the area still going to be in high demand? And this project checks all the boxes. It's on the Line 1 subway, the Young Line. It's near Ryerson. It's actually across the street from Ryerson. And it's walking distance to UFT. It's also steps to the financial district. So it covers it both. The developers are top shelf. Like I said, I invest there. Okay. And that area is never going to go dull because of the universities, because of the financial district, because it's right smack downtown Toronto. Okay. It's condominium ownership nestled with the premium resort offering. Okay. Sorry, that was Kayla put in the wrong comment there. In the heart of downtown Toronto, just north of Yonge and Dundas Square, 8 Elm is currently home to a designated heritage building. They are keeping the heritage building on the ground floor. Okay. It has a 20-foot ceiling, and they're going to have a 14-foot scale model of this. These new downtown Yonge condos will be integrated into the new development's podium to ensure the street's historic character is properly preserved. It is well served by transit, 100 transit score, steps from Dundas Station, 2 24-hour streetcar lines running east or west, across from Ryerson, minutes from UFT, short ride to OCAD by transit, okay? There is one condo on Yonge Street that launches for every 100 condos that launch in the city. And that's the truth about it. Land on Yonge Street is very hard to come by and assemble and build something like this. So when you buy anything on Yonge Street in the city, you are buying the elite. And this is what it is. I would love to say that I had input on the design, okay? It is not your glass box in the sky. Almost every unit has a balcony. There's beautiful brass exterior, and the material that it's chosen does not change color, and it handles the elements extremely well. It has a curved section on the ends. It is a beautiful building, aesthetically pleasing to look at, and it'll stand the test of time. And every expense, okay, has been considered, and they're actually not building this solely to make money. They're making less profit on this because it is their flagship. This is a building where 2 developers that are highly successful got together and said, let's build the best we can build. And that's why I'm buying in this myself. That'll be launching the 2nd to 3rd week of September. Little insider info, prices will start in the 1700s to 1800 per square foot. In comparison, Concord Sky across the street was selling 1800 to 2000 earlier this year, okay? So Capital Developments and Reserve decided that for the first block of units, they're actually gonna underprice them, even with increases in development charges, even with increases in construction costs, because over the course of 838 units, okay, they'll make up their money later. So in this first round, I am buying, repeat clients of mine buying, and old friends of mine are buying. So if you guys want, reach out to Paul and he'll get in contact with us, or reach out to us, okay? We're not sure we're gonna do that yet, but we can get you in first. Now, I'm gonna bounce around to different areas of our region because I think not everybody can afford, and their first project to invest in is right on Yonge Street. So we're gonna shoot over to Hamilton. Hamilton has been a forgot about part of Southern Ontario for too long. And now it's gonna make its bounce back on the map. $4 billion is being invested in Hamilton for multiple levels of government. 4 billion with a B. It's almost an Austin Powers moment, okay? And when there's that much money being invested, areas gentrify, areas explode, areas do great in all the ways that they can be. So Design District is being built by Emblem Developments. Cash Pursuit, a financial genius who manages over $4 billion in people's private wealth, decided to start a development company and brought everything about him that made him successful in finances into the development game. These guys build so well that they, okay, here we go. I'm gonna answer this question. Okay, DJ, I had commented a little earlier that when you're buying pre-construction condos, it's not a cash flow, It's not a monthly ROI type of investments. They're only assets and only capital appreciation. And you need to be comfortable with that. And they're not for everybody. But for some people that have a large portfolio, they complement those. Okay.
It
Now we'll
costs.
get back to this.
If I can interrupt for a second, the way I describe it,
Yes.
I'm full of cheesy analogies. And think about it, if you were building a house, you need lots of different tools, but you're not going to go to Home Depot and buy 100 hammers. You only need one, right? So pre-construction and the right kind of projects, they are tools in the toolbox. You can't buy all duplexes and all certain types of assets because you pigeonhole yourself. When you need the right tool for the right job, and if you have cash setting aside and you can do multiple different things, this plays a role for you.
And what I like to say, and that's why I like to diversify when I do these presentations and these seminars, I bring projects from every price point. We started at 17, 1800. Now we're going to 1100. Okay. Now, a little known fact about Hamilton, then I'll go back to talk about Emblem, is rents in Hamilton. There's 2 beds right now. There's a huge shortage of new product, new condos in Hamilton. And I know I've been talking to people are like, oh, I can buy a two bedroom in Hamilton for $300,000. You know what? You can, but your 2-bedroom condo for $300,000 is going to be worth $300,000 5 years from now. It might even be worth less. Okay. Now, new condos appreciate much faster than older ones, and they also demand a significant premium on rents. So keep that in mind. So Design District is being built by Emblem. These guys are so confident in their construction that they have live feeds on all their construction sites, so buyers can click in and see the progress. They are so particular that all their sites have specific cranes that are bought in Italy, shipped here and assembled because they are the best. So that is what they're bringing here. So let's go to some pictures, Kayla, and show us some of this beautiful project. Okay. Now, when you think of high-end designer lobbies, you think of Yorkville and areas like that. 8 Elm is going to have that. This project in Hamilton, its lobby furniture is designed by Louis Vuitton with a $500,000 budget for each of the 3 lobbies. Okay. And Bertie Felick, which does the interiors of world-class hotels, like the best of the best, they're doing the interior design. So what we're getting in Hamilton for slightly more than other projects is we are getting the landmark project in Hamilton for at least the next decade, at least. And I guarantee you that this will demand a significant higher rent than any other building in Hamilton. Okay. Next slide. Now, when we talk about transit, we don't really think that much about Hamilton. We think about Toronto, but they have a brand new LRT coming, steps from Design District, and it's only a few stops from McMaster. So remember I said transit, education? Hamilton is also number 4 for tech talent in Canada. That's a little known fact. So there are some very high paid tech people there looking for places to live as well. So it's not the steel town that we grew up thinking it was. 3 minutes to the Hamilton GO Center station, 3 minutes to the West Harbour GO station, 2 minutes to the new LRT. Okay, that's drive time. And these are all within a 10-minute walk. 97 walk score for this project and a 93 bike score. Continuing the path of condo living, making everything within walking distance. 3 towers, over 900 units. Go on, Kayla. Now, that was Hamilton. So remember, if you can't afford for your first purchase, or it doesn't make fiscal sense to pay $1,700, $1,800 a square foot, and it doesn't work for all. I don't usually put people in that project first, unless they're high net worth individuals. I would put them in something smaller, smaller in price, where there's greater room to appreciate. Think about the 8 Elm building being like a blue chip stock. It'll always be a premium product, okay? You might not get the same level of appreciation, but you basically know what you're gonna get. And Yonge Street will always be Yonge Street, and downtown will always be downtown. But the Hamilton product is a great, more affordable way for many to get their feet into the pre-construction pool. And don't be worried about rents in Hamilton, because there's very little new condos. There's a lot of students that go there, and housing is 1/10, okay, of the population, if that. And there's tech talent jobs there that are high paying, and rents in Hamilton are close to 70% of Toronto's, but price is significantly less, sometimes half, okay? Now, I love Etobicoke for investing. Why? Because Etobicoke is 12 minutes to downtown in traffic, but prices are significantly different. Here we have Curio around $1,400 a square foot, boutique building, okay? So there's gonna be less investors, more end users. And this is built by Marlin Springs, one of the best companies in Canada to work for. It was rated not by me, okay? But it's also one of the fastest growing companies. They have partnered with Damac International. Their claim to fame is they build the best of the best in Dubai. So all the crazy buildings in Dubai that you see on TV, I was mesmerized by them. They're built by Damac. They partnered up with Marlin Springs to do their first building in Canada, and they started with a little one. This is a great looking building that's gonna have great finishes. Next slide. Curio is gonna be 10 stories, 206 units, right on the Queensway, right by Royal York, steps to the GO station, steps to the Gardner, okay? So we got transit, we have TTC, all within a 10-minute drive. We have bike lanes, grocery, everything's within walking distance here, okay? And it's situated between Islington and Royal York, and anybody that knows that area knows there's a lot around there, and it's steps from downtown. Steps from downtown, but pricing is gonna be $400 to $450 less per square foot, and it's a boutique building, more end users, less wear and tear. Now we're jumping to Vaughan, the Vaughan Metropolitan Center. And we've seen a boom of development in Vaughan because of the amount of jobs and because of the subway being there. Now, this is just on the north side of Highway 7, east of the 400, west of Jane, in the actual VMC. Now, this is being built by Smart Center's real estate residential division called Smart Living. Now, they're one of the big commercial real estate holders in the country, one of the biggest, and they have a whole pre-construction, their whole residential pre-construction division that's building 10 towers here. This is where their head office is located. So no one is gonna build something that they're not proud of and they can see from their window every day. And that's what's happening here. So this is the second and third tower of 10 towers that they've launched, 48 and 56 stories, okay? We still have some great units left in the first building, and this is gonna be around $1350 a square foot. These towers rise above the premier 9-acre Central Park, only steps from the VMC subway. Smart VMC is a master plan of pedestrian-focused dynamic urban development comprising over 100 acres and 20 million square feet. This is not a small project. This is massive, okay? When you move into this, it is redeveloping an area. Now, I know Center Court has some 5 Transit City buildings that they built. This is gonna be the Toronto, north of Toronto, by the time this is done. If you buy in early, you will see the beauty of synergy when it comes to condos. The more condos that are built around you, the more people view it as the condo hub, the more traffic you get for rents and resale, and the more increase in price per square foot you will have benefit from, okay? Smart VMC will eventually be home to 45,000 residents. And the newest hub offers dining, culture, recreation, parks, open spaces, and more. It is a true master plan community, and the livability is very, very high. So remember, what these master plan communities are doing, they're creating cities within cities. And what comes with this is billions of dollars of infrastructure. So everything is new, everything is nice, everything is the way that it should have been designed, but it wasn't where you used to live. Next slide. So Paul, is there any questions that you may have, or should I answer some questions, or should I talk about how it's a little different to buy this than the usual?
Very impressive, Costas. I love it. I liked everything you had to say, and the projects are fantastic also. I know I sound like a salesman, but I can't help it. I was impressed. But let's answer some questions. If okay. Feel free to unmute yourself, people. This is don't be shy. No judgments here. Ask your questions, and if you're more comfortable, put it through the chat, and we'll call them out. So we'll hang out here for a bit while you kind of deal with your questions. I think a common question is going to be, how can people get more information about some of these projects and get in first and if they want to line up for some of these units. And we didn't talk about it too much, Costas, but I think we can give you guys a list of all the people who registered, so we can make sure they get first access if they're interested. And then we can share some of the information when you guys have it ready. Would that be fair with everyone?
Yeah, that would be great on our end. What you're gonna my staff member that speaks to specific people that we want to prioritize. Her name is Ashley, and she will be contacting everyone. We'll start with an email. We'll do a follow-up call, text. Listen, I want to tell everybody this. Pre-construction investing has done wonders for my family. It insulated me from a very expensive divorce, okay, one that would have destroyed most people. It actually insulated my former partner, my former common law wife, the mother of my children. I was really happy that it was able that we could go unscathed, essentially, okay, from the investments that we had made. And I've made a lot of people a lot of money. And I know it's not right for everyone, but Paul had a great analogy in the metaphor of it's a tool in a toolbox. And everything has its time and everything has its place. And if you don't really need cash flow and you can start buying hard assets for capital appreciation, there is no better product, no better vehicle in real estate for your money than pre-construction. And we've seen those numbers. These are numbers that we've benefited from ourselves personally and our clients. And over the past 6 years, we've seen increases, like based on your deposit, 50% annualized returns. And these numbers are real. And you know, this is not the stock market where somebody across the world who has more money than you can even imagine decides to press a button on a keyboard and destroys your stock. That doesn't work like that. There's safeguards in place. We're the safest place to invest on the planet. That's why we sell the most units. And what I'm going to do now is I'm going to go into some questions. Okay. I'm scrolling through here. What do I think about investing in Calgary? We do some business in Calgary. I was just talking to my fiance today. We may be buying a unit in Calgary. I've already bought one unit this year, and I'm going to buy another one at 8 Elm. So if anybody thinks that the market is scary and it's uncertain and it's unstable and this and that, well, look at me. My life is pre-construction condos, and I'm buying 2 units this year. Okay, and the second one, the first one is no brainer, but the second one I just can't pass up 8 Elm. So Calgary, great idea. I was talking to my significant other about it. We do some business in Calgary. Costs are a little bit lower. The reason I was staying away from Calgary for a while is because it was usually tied with the oil markets and it was very volatile. But you're seeing significantly changes in the demographic of their economy. Okay, and I think it's stabilizing. I think it's doing really well. That was a great slide.
I have a question, and maybe it's unsophisticated because I'm not a huge pre-construction guy. I've done a couple in the past, and I've certainly built them. And I have 2 coming, one in Burlington and one in Oakville. But both of them are in kind of 800 to 900 square foot. And for me, just in my own head, like that's like a comfort zone for me. And I'm just being honest, like it's hard for me to fathom. Holy shit, 1,200 square foot. How do I make more money on that? You know what I mean?
What you need to do is first you need to eliminate yourself from being in a place where 800 to 900 square feet is comfortable, right? Now, you need to look at the rest of the world. And a lot of people are coming here from areas in the world where 300 square foot units are quite common. Okay, we haven't reached that level yet, but we do have some, but the bulk of our buildings aren't considered studios or junior 1 bedrooms, which don't actually have a bedroom in 275, 325 square feet, right? But you need to understand that people are living in these places for convenience. The people that live here in these smaller units, okay, it's an affordability issue too. Now, the reason Manhattan is so much more expensive than us is not really price per square foot. It's because the bulk of their units were built when 800 square foot 1 bedrooms were the norm. Mm-hmm. So their 2 bedrooms were 2,000 square feet.
Yeah.
Here, because we're a newer city and we're building things newer and recently, it's all based on price point. So you have to eliminate, when people say, what's the best unit as an investor? I tell them the smallest 3 bedroom you can get your paws on near a university.
That's right.
Because if you can get an 825 square foot 3 bed and you can rent it out to 3 international students whose parents give you 1 check for the year, then you're making $40,000 a year cash flow. So to answer your questions about cash flow, I know how to make cash flow with these, but not many people can wrap their heads around it. But for those of you that have the bank and want to make cash flow, I will make you $30,000 to $40,000 a year cash flow on a condo, and it's happening. It's not rocket science, right? But for the majority of people, you go ahead.
No, I think for a lot of people who are strictly cash flow based, we forget that other assets provide other advantages. And I think a big one too, for example, like those condos in Vaughan, and we got one of those. And you know what I was thinking, my main driver for that one, it wasn't even profit. I knew I'm going to make money in it eventually. And it's not a case of if I'm going to make money, it's just a question of how much I'm going to make in a certain amount of time. But it was family driven. I'm like, I got 3 young daughters. I mean, if I don't buy these kids a house now, where are they going to live in 10, 15 years when they move out? And, when I'm teaching a class live, I don't mean to sound crazy, but I'm sick of doing Zoom. I want to see people in person. I always poll the room. And I'm like, who's got kids here between 15 and 20 years old? And inevitably people are going to put up their hand. I'm like, hey, you buddy, like, what are you going to do when little Johnny wants to move out? Where's he going to move? In Oakville? Are you going to buy a house in Oakville? No. You buy a house in Burlington? No. You going to buy a house in Mississauga? No. Is he going to buy a house in Hamilton? And we used to say yes. Oh, Hamilton's the place. Now, no chance. You know what I mean? So I'm thinking ahead of time and like, how can I secure assets for my family when they're not going to have a chance to do that? And it was just a different advantage that I think a lot of people resonated with who have families also. Interesting.
And I love your point, and thank you for saying that, because you actually reminded of one of the mainstays of what we do. We build generational wealth. That's what I like to tell people, right? And people say, "Are you a real estate agent?" I say, "No, I'm a real estate investment consultant that builds generational wealth for people with one simple down payment." And when I ask people when I meet them, the first question I do, Paul, is I say the same thing. And we did a very big seminar. A brokerage in Hamilton invited us to teach them about pre-construction, and a bunch of clients showed up. And I asked everybody, "How many kids do you have?" And everybody said 1, 2, none. I'm thinking about 1, et cetera, et cetera. And I said, every kid you have, think about this. You buy 1 pre-construction condo for each child. By the time it's ready, based on what we've seen and based on immigration numbers and scarcity and all that, there will be enough equity built up over the course of the build that by the time it's built, you can refinance via HELOC, pull out that money and buy another condo. So now 1 condo became 2 with very little money out of pocket. So you can build real estate portfolios or just buy 1 and set up your kids for their future. Because death, taxes, and real estate getting more expensive in our region are 3 guarantees in life. And that's the truth. And we help people build that up, because I tell people, listen, we've seen inflation this year. For the first time in, I don't know when, I actually looked at a bill and didn't know what something was and went back and asked, because it was so much more expensive than it was a month ago, right? Mm-hmm. So if I'm doing that, and others I'm sure are doing that don't usually do this. Like I remember my mom, when we used to go grocery shopping as a kid, she would stare at the till to make sure nobody was ripping her off, right? So I don't do that, but I actually did it. Now, imagine how much more expensive it is by the time we retire.
I know, man, it's crazy. You're making
so we won't be. I know this is our childhood growing up. So the thing is, if you don't set up your kids' financial future now, when it's semi-affordable and there are opportunities, you're not going to be able to do it, and you won't have enough money to survive your golden years comfortably and still do it at the same time. So you really need that thing, foresight, that we talked about. And if that's exactly what I tell people to do. How many kids do you have? Buy a condo here, buy a condo there, buy 1 for each kid. Let me do what I do. And if your kids are young, by the time they're finished university, they'll have 1 or 2 or 3 properties. And that'll be to help them with their financial security.
Yeah, I think that's interesting. It's something anyone with a family has to look at, because, I mean, you don't have a choice. I mean, we're not going to be able to afford anything anyway. And another interesting benefit that I'm finding, especially in the kind of uncertain times with rates raising right now, is anybody who's got cash in the bank, even if it's 100,000 or 2 or 500,000, even $1 million. And, being in the real estate investment game, a lot of my clients are sitting on $500,000, $600,000, $700,000 not knowing what to do. If you're unsure, and confused minds always say no. That's why I want clarity in anything I do. Confused minds always say no. At the very least, even if you're not a huge fan of pre-construction, I think parking your money in a high quality pre-construction project is better than letting it sit in the bank, because you got $200,000 sitting there, and inflation's kicking at 10%. We all know it's more, but we'll use 10% for math.
Exactly.
Next year, you didn't lose any money. It still says $200,000. It still has 5 zeros there, but you lost purchasing power. We all know how inflation works. If things are not actually getting more expensive, it's the value of your money is depreciating so fast that it takes more dollars to buy the same product, right? So would you rather have a down payment in a high quality condo that's going to make you a bit of money in the future, even if it's not 50%, even if it makes you 20%? Or would you rather be losing 10 or 20% in the bank? That's, for the first time in my life, I'm thinking that, like that, the inflation's so high, you have to consider that in your plan, right? So
and you know what, and that's the same way. And I got to chime in there and agree with you, because buying it, I bought a condo outside of Toronto that's by a ski hill and stuff, because I used to ski a lot when I was younger, and I don't have anything, a cottage or anything like that, right? And I like where we bought it. It's a 4-season resort, so I think it's great because I have young twin boys and a stepdaughter the same age. And I think by the time it's ready in 3 years, they'll be at a great age where they can go out and have some fun on their own, and we're all there and get out of the city a bit. But the 8 Elm buy, I can't pass up. And to say I have millions of dollars sitting in the bank where I can purchase a condo at 1,700 a square foot without thinking about it properly, I'm not at that level, right? But as opposed to leaving money in the bank, and as Mike Cook said, they're debasing our currency by continually printing more money, okay? Instead of doing that, I'm gonna buy a hard asset. And in times of uncertainty, people that know what they're doing and have money, they shift their money to hard assets, things that can weather the storm. And these things will, these condos will. And it's strictly based on supply and demand. And that's what I'm doing. And if I'm going to do it, and this is what I do, I highly advise others to follow suit. Yeah,
interesting. I think somebody was asking about Calgary, and Dan, being Costas, being who he is, he's going to have access to projects there. He may not have anything right now, but now that we know Costas and he's a friend of ours, when he does have access, he'll let us know, and we can always take a look at it. So
yeah, and listen, you guys can register. We'll get the list from Paul. We'll actually reach out to everybody. And if there's nothing on the First Access Condos website, firstaccesscondos.com, okay, if there's nothing on the website, okay, then reach out to us, register, and then in the comment section say, I'm looking for this, and we will find you something similar, an apples to apples comparable. And to Daniel, you can reach out to Ashley and tell us why you're looking at Calgary as opposed to our area here, and we can maybe steer you over here if we think it's a better fit for you, or easily assist you over there as well. Now, Andrew has a great question here. What is better, pre-construction versus an assignment for pre-construction? Now, here's what I don't like about assignments. The money you make in pre-construction is during the construction process. If you're buying an assignment, you're buying it later, and you're also paying a profit to the seller. So part of the profit you could have made is going to the seller, okay? Now think about that. Why not write it out?
I think Andrew's more talking about, if I'm going to buy a pre-construction, is it better to just close and hold it, or should I sell it before closing and kind of take that profit early?
I am very against assignments. The only two people that make money on assignments are one's an entity, the CRA and a realtor. Okay, the realtor makes his commission. The CRA taxes that into oblivion. It is not a capital gain because it's not real estate. You're selling a piece of paper. So no transaction as real estate is happening to qualify as a capital gain. It is 100% income. They also started charging HST on it, and they are looking at everybody. They're double dipping on this one. So if you're gonna, I would rather put my clients in private money and then sell the property after it closes and registers than have them do as an assignment. And I can go more into that in depth in that over a phone call or a Zoom. but just trust me on that. Assignments are a last resort, and one that I would rather you pay 8, 9, 10% interest, okay, for less than a year and get out. You'll make substantially more money. By the time the government's done with you, you'll be making 25% of the money that you got.
Yeah. Yeah. I think that's a good point. I'm glad you said it and I didn't have to do it because, going into the deal with the notion that I'm going to make money from the assignment, that means, like, to me, that's saying I don't trust the project. You know what I mean? Like, you want to get out before you're going to close, like that. You're supposed to be closing on it because it's a good deal, because you want to rent it, because you want to hold it long term. If you don't want to hold it long term, then it's purely speculation, and that's essentially gambling. You might as well go bet on Reddit at the casino. You know what I mean? But
well, the reality of the matter is, right, there's an appreciation curve, and the appreciation curve is significantly higher with new construction once it's built than anything for after the 5-year mark is when it goes from new to old. So the maximum appreciation you're going to make on your pre-construction unit is year 2 to 4. So that means you get the keys at year 0. During that first year, you're going to see an artificial spike and drop in per square foot, because people are going to realize that for whatever happened in their life, they might have to fire, sell, liquidate. So you don't want to compete with desperate people. But year 2, those people have fizzled out, okay? And that is when the true value of the project is attained. And then up until year 4 or 5 before it becomes old. That's really what you want to keep your unit for, okay? Now, if you're going to sell it in an assignment, it's usually once the building's about 75% complete in construction, when you're allowed. Now, why not? You're not putting any new money into it. You're just closing. And if you have trouble closing, there's lenders and private lenders, worst case scenario, that'll help you with your closing costs and incorporate that into the loan because of the equity that's built. Trust the project, trust the advice of the person that told you about it, and stick it through. Nobody has ever said I steered them wrong if I told them don't assign it. People that assign it, even against my advice, they always come back and say I should have listened to you.
why don't we cover one more question, and then we're getting close to 9 o'clock here. So, and we'll end it, and then we'll obviously give everybody the recording. We'll give everybody Costas's contact information. Costas will have the list of everybody who joined here and who saw the recording, and he'll reach out about the project. Who's got one more question? Parking.
We have a, yeah, I was going to jump to that one. Go ahead.
Parking's a great question, okay? Parking at 8 Elm is going to be about $150,000 to $160,000. This is not the new high. There was actually more expensive of $185 last year, okay? If you do not buy a large 2-bedroom or larger, you shouldn't even consider parking downtown.
Really?
Don't even consider it. It doesn't make sense. You should never buy it unless it's a 3-bed or a large 2-bed, and not just an investor-based 3-bed. If it's a 825 square foot 3-bed near a university, don't buy it. The only people renting from you are going to be students that don't have cars. And if they do have cars, they're very wealthy foreign students, and they will pay for parking somewhere.
Yeah.
Okay?
I know
the numbers don't make sense.
I noticed in other projects outside the city, like the ones I have in Burlington and stuff like that, like parking was included in the price. So I think in different markets, parking's, dealt with differently. But depending on where you are and what the nature of the location is and who's driving and parking in transit, I mean, that can be a real, it can make a difference.
Well, now, no matter where you buy now, and we have a project coming up with Burlington Core. It's the last lakefront address for condos down in Burlington. We also have a project, Gemini, coming up in Oakville, okay? Even buying at these projects now, parking is limited to maybe large 1+ dens, but it usually starts at 2 bedrooms and larger. Everything is kind of getting away from the car, and developers, it actually costs them more sometimes to build the parking than to actually sell it, depending on the area. Now, even if you're buying parking, there's no more parking included anywhere. But even if you buy parking in, say, Burlington, Hamilton, Oakville, you're still paying close to $40,000, $50,000. So you really need to think about it, because it's a lot of money. And with current mortgage rates, you need to be making over $300 a month more to cover your parking costs. Mm-hmm. Is it going to work it? Not for all. And that's where advice by someone like myself. And don't get me wrong, I came from a generation that when I turned 16, on my 16th birthday, I had a driving test booked all the way in Oshawa from Toronto because I wanted my license so bad. But times have changed. So talk to me and I'll give you an unbiased opinion.
Yeah, no, that's really good. It's good to see that, you can give people the real deal from experience. So everyone, I appreciate you guys joining. And if you're watching the recording, thanks for taking the time in your off time to watch this. And we'll be in touch. What's the next steps? I left you guys that. We'll be in touch with information on the projects, but the economic info we shared hasn't changed. And if you still like the cash flow stuff, you know what we do. Well, we can talk. Okay. In the email, when I send this recording out, we'll leave a button for you to contact me if you have any questions. And we want you guys to take action. That was the name of this presentation. Okay. We want you to persevere in the end, but get informed first. So on that note, I'll thank Costas and his team. And thanks for all of you for joining.
Thank you, Paul. It was a pleasure. It's always a pleasure. Any chance I get to talk to someone that has the same ideology and the same train of thought, it's just, we complement each other today with synergy, and I hope everybody will benefit from us.
Okay, my friend. Talk soon. Ciao. Buonanotte. Have a good night.
Bye, everyone.